If you spend any time online at all right now,
Yeah.
you are just drowning in AI headlines.
It's everywhere.
Yeah, we're talking about stories that promise these, trillion-dollar transformations. We're seeing startups with almost no revenue, sometimes just theoretical revenue, commanding these valuations that just make your eyes water.
It feels less like a slow evolution and more like a financial big bang.
Mhm.
I mean, the sheer velocity of money moving into this space, the chips, the models, the apps, it's just staggering.
And executives are dropping the word generative into every single earnings call. The
Yeah.
capital's flowing faster than I think we've seen in decades.
It really is. And the narrative is so powerful, this idea that AI is the next big platform shift, that it's driving investor behavior based almost purely on FOMO, the fear of missing out.
Exactly. So we're watching this incredible frenzy, but, underneath all the excitement of the really stunning demos, there's this crucial, almost uncomfortable question starting to surface. Are these breathtaking valuations actually supported by real sustainable profits? Or are we all just watching an economic hallucination form in real time?
And that right there is the core mission of this deep dive for you. We are going to dissect the generative AI boom, really pull apart the hype from the hardware.
We need to figure out if these skyrocketing valuations reflect genuine innovation,
Yeah.
or if this is a bubble just inflated by pure speculation.
So over the next few minutes, we'll guide you through the frenzy, we'll examine the hard economics, look at some frankly eerie historical parallels, and then identify 4 key pressure points that could reshape the entire tech landscape.
Let's jump right in. Let's try to set the scale of this AI gold rush.
The scale is really what makes this cycle so different. We saw the surge really accelerate in late 2024 going into early 2025. This wasn't a gradual climb like some of the other tech waves.
Yeah, it was an explosion.
It was an explosive re-rating of assets across the whole ecosystem.
And that's the core paradox, isn't it?
Yep.
You have these firms, some are established, some are brand new startups, with limited margins, products that are still changing wildly, and suddenly they're being valued in the tens, sometimes hundreds of billions of dollars.
They're being valued like mature, cash-generating companies, not, R&D projects.
Right.
And that paradox is only possible because of the power of the narrative. Generative AI just looks different. It feels different. It touches the act of creation itself.
We're not just talking about automating a spreadsheet anymore.
No, not at all. We're talking about code that literally writes itself. Images, video, all generated from a single sentence. It feels like magic.
And that distinction, that this isn't just about automation, but about replacing a piece of human creativity, that seems to be the engine driving all this momentum.
It created this tidal wave of FOMO. Investors are terrified of missing the next Amazon, the next Google, and that fear just overwhelms any kind of rational valuation model.
And that capital, it's not just going to the big model builders, is it? It's going everywhere.
It's flooding the whole landscape into the infrastructure, the NVIDIAs of the world making the chips, and into thousands of tiny application startups. We even saw that trend of companies, sometimes struggling companies, just adding the word generative to their name to catch the wave.
A classic gold rush. Everyone's running to the field, hoping to strike it rich.
But history shows us time and again that the initial rush is always followed by a pretty painful reality check, once the actual expensive digging has to start.
And that reality check brings us right to the uncomfortable truth, the profitability puzzle. We have to look past the demos and the big numbers and see what money is actually being spent and what's being earned.
Right, because for all the amazing things generative AI can do, actual sustainable profitability is, well, it's still stubbornly elusive for most of the big names.
They face these core economic problems that are rooted more in physics than in business strategy. So what are those core cost problems that are just eating away at the margins?
In a word, it's compute. We are not in the old world of software as a service where, the marginal cost to serve one more user is basically zero. Here, every single query, every time you generate text or an image, it requires immense, sustained, and very expensive compute power.
So when I ask a complex question, the cost isn't just keeping a server on, it's the actual consumption of super specialized, expensive hardware. Is that right?
Precisely. We're talking huge clusters of very expensive GPUs. And there's a critical difference between the cost to train a model, which is a big upfront cost, and the cost of inference,
Inference being.
serving live queries from users. And that cost scales directly with usage. The more popular your service gets, the more your costs explode, often faster than the revenue you're bringing in from those users.
And it's not just the silicon and the electricity, right? There's the data.
Absolutely. There are massive ongoing data acquisition costs, the constant need for model retraining to keep it fresh, fine-tuning. When you add all of that up, the margins for these general AI services become incredibly thin. Often they're just non-existent. They're operating perpetually in the red.
So if the cost side is that brutal, where is the income coming from? What are these companies relying on to justify those huge valuations if sustainable cash flow isn't there yet?
Well, they're relying heavily on what you could call the revenue illusion.
The revenue illusion. Okay, unpack that.
It shows up in a few ways. One is heavily subsidized usage. They give the service away for cheap or even free to acquire users and, more importantly, user data.
So they're buying data with investor money, essentially.
Essentially, yes, hoping that data creates a lock-in effect down the road. They also run these enterprise pilots that are effectively deep discounts, but a lot of those don't convert to the big long-term contracts they need. And crucially, they're relying on constant, massive injections of capital from investors. Their operations are literally being funded by the belief in their future, not their present.
That's the critical gap then. The huge distance between today's losses and tomorrow's promised profits. That's the very definition of speculative risk.
And it raises the big question. Can these business models ever scale profitably without an infinite supply of funding? Because what looks like revenue growth right now is often just usage growth paid for by VCs.
Which is why we have to look to the past. Because as you said, we have seen this movie before.
We have, and the plot points are disturbingly similar.
And looking at the past, it's not about trying to predict the exact date of a crash. It's about recognizing the patterns, the emotional and financial patterns of a market frenzy, because that part of human behavior, it doesn't really change.
And the most obvious parallel is the dot-com era. The late 90s, the red flags are identical. You had companies going public with absolutely no profits.
Right. Valuations were based on eyeballs and future potential.
Exactly. And the price-to-sales ratios, which should be in the low single digits, were soaring to 50, even 100 times sales.
And anyone who dared to bring up boring, basic fundamentals like, earnings or cash flow, they were dismissed as old-fashioned. This time is different.
You just don't get it. We heard that all the time. And we saw it again more recently in the 2021 SPAC frenzy.
Oh, yeah.
Identical behavior. Narratives completely replace numbers. Companies with growth projections 10 years out into some perfect hypothetical future. Risk was just reframed as vision.
But I do have to push back a little here.
Yeah.
Isn't generative AI fundamentally different in its adoption? The internet required you to go buy a PC, get online, learn how to use a browser. AI is being baked into tools we already use right now.
That's a valid point, and it's the essential counter-argument. The technology is being adopted faster than previous shifts, no question.
Sure.
But the lesson from history isn't that the technology fails. The internet didn't fail. The lesson is that the market structure built around the technology often fails.
Okay, so that's the crucial nuance. The technology can be world-changing and transformative, and at the same time, be vastly overpriced in the market.
Precisely. The internet was real. It changed everything. But thousands of companies like Pets.com and Webvan, built on unsustainable models, they still collapsed. They destroyed billions in capital. AI is real. It's powerful. But that doesn't make every company with AI in its name immune to economic gravity.
That perfectly separates the innovation from the valuation. So, okay, if we accept the air is getting thin, what are the specific pressure points, the unique risks to AI that could actually cause this bubble to burst and maybe trigger a real AI winter?
I see 4 key threats emerging, and what's worrying is that they're all happening at the same time. They're all interrelated.
Let's walk through them. Let's start with the regulatory side.
Okay, trigger number 1 is regulation and compliance. Governments all over the world are waking up and putting scrutiny on data usage, on training rights, on model accountability. This means compliance costs are going to skyrocket.
The Wild West days of just scraping the entire internet for training data are over.
They're definitely ending. And that leads directly into the next threat.
Which is?
Trigger number 2, intellectual property challenges. The very foundation of these models, that they were trained on massive, often copyrighted data sets, is now being challenged in court.
All those lawsuits from artists, authors, news organizations.
Exactly. If the courts rule against the current training methods, it could be catastrophic for some of these models. It could force incredibly expensive, time-consuming retraining using only licensed data.
Which would completely redefine the competitive landscape overnight. It would favor companies that already own huge proprietary data sets.
Okay, what about the market itself? The competition?
That's trigger number 3, commoditization. The competition, especially from open source models, is relentless. They're getting better at a breathtaking pace, closing the performance gap.
And as they get better, the pricing power of the big proprietary models just collapses. It collapses. If a free open source model can do 80% of what your expensive proprietary model can do, AI stops being a premium product and it just becomes basic infrastructure, like a utility.
And that is the death knell for any company that's just a reskinned API.
Precisely. A company that just puts a pretty interface on top of a foundational model without adding real value. Their entire business model evaporates. Why pay them when you can just use the open source model yourself?
The path to a $100 billion valuation for that kind of company just disappears.
Okay, and the final trigger.
The final one is trigger number 4, adoption reality and failed ROI. Businesses are all experimenting right now, but full-scale adoption is expensive. It's disruptive. If those promised productivity gains, the return on investment, don't show up fast enough or cost too much to implement,
The budgets get cut.
the budgets get cut, the pilots aren't renewed, the spending shrinks. The bubble could burst not because AI failed, but because the market's expectations simply outran the economic reality of corporate integration. So we've established AI is real. The bubble risk is also very real. For anyone listening and trying to navigate this, the strategy has to shift. It has to go from just, enthusiastic adoption to intense, almost surgical scrutiny.
Absolutely. The critical distinction you have to make is between the likely long-term survivors and the inevitable failures. Because the collapse, if it comes, won't be uniform. It will wipe out the speculative froth, but leave the truly foundational companies standing.
So what are the traits of those long-term winners? The ones that will survive a correction?
I think they need 3 things. First, a clear, credible path to profitable scaling, where revenue actually outpaces those brutal inference costs. Second, deep, sticky integration into a business workflow that makes it really hard to rip out. And third, a defensible advantage that goes beyond just having a big model. We're talking unique data, niche expertise, maybe some kind of hardware optimization.
And on the flip side, where is the capital most at risk?
It's most at risk in those companies built purely on hype, the reskin APIs we talked about. Any business whose basic economics require perpetual funding just to keep the lights on, their business is built on investor goodwill, not on customer cash flow.
So let's distill this down into some guiding principles for anyone analyzing this market.
I would say, first, demand margins, not just demos. Look for usage that sticks, not just free trials.
Okay.
Second, separate the infrastructure, the chips, the core models from the applications built on top, which are more likely to be commoditized. And above all, avoid businesses that need infinite capital just to survive the next quarter.
The foundational shift is real. It's happening. It's like electricity or the internet. It will change everything. But not every company riding this wave of speculative money is going to make it to the other side of the correction. Innovation drives the hype, but economics. Economics always wins in the end.
That's right. The generative AI boom is creating genuinely world-changing tools. And at the same time, it is on track to destroy enormous amounts of speculative capital. Both of those things can be true at once.
So the real test isn't whether AI is powerful. We know it is. The test is whether today's valuations reflect reality or just imagination. Economic hallucinations feel very real right up until the moment they don't.
So we'll leave you with this final thought to consider. When innovation moves faster than economic sustainability, who pays the price when the illusion finally fades? Because in every single bubble, someone believes they're early, right until the moment they realize they were just late.
Continue your research into grounded analysis on technology, markets, and systemic risk. Thank you for joining us for this deep dive.